Okay, are we ready to start? Is everybody ready to go? Christine, are we good to go?
Yeah, Rob, go ahead. Sorry about that little glitch. It accidentally kicked us off the stage, but we are good to go now. I've got the screen shared and you are coming in loud and clear.
Okay, great. Well, as Christine said, thanks for coming today. Again, my name is Rob Ennis, and I'm going to talk a little bit about succession planning. And I guess if you go on to go ahead and move to the first slide, the introduction slide, Aaron. Keep going. There we go. So, I want to start off with what do we mean by succession planning in the context of this presentation. Succession planning can mean lots of things to lots of people. But first and foremost, I just want to mention it's not what you would find if you were working for or have worked for a bigger company in the past, which is basically who's our next CEO. Really what we're talking about is planning your exit strategy. If you own a business, what are you going to, what's your next step? And what are you going to do? Transfer ownership, transfer operation, and then move on to your next thing. And that transferring of the ownership can involve many things. And each one has its own characteristics, whether you're transferring it to a family member who currently works in the business, an employee who works in the business, or someone who's buying your business. Each one of those has its own characteristics, and we'll touch a little bit on general aspects of those. And then probably just as important as the transferal of ownership is what are you going to do next? And whether that's retirement or whether it's part-time consulting, volunteering, fishing, whatever you want to do. Those are all things that you really need to think through and think about at some level. And as we go through this, I think you'll see maybe have get some handle on just all the aspects that are involved. And it's not a simple thing. It's very involved. And this presentation is not going to, by any means, be an in-depth presentation and cover everything to the nth degree. But I'm going to try to hit the high spots and the important points, and hopefully, give you a little better understanding and just help you to think through this process. Okay, Aaron. So first thing is planning for transition. There's the old saying, it's never too early to start planning, and that applies to this activity as well. I think we all, to some degree suffer from the, I'll get to that later, kind of thought process. You just need to be careful in this context to not get into the mode of, I'll start planning in 5 years because I'm not ready to retire yet, or I'm not ready to sell the business. Because one thing leads to another, and it just pretty soon it's 10, 15, 20 years down the road, and you haven't done any planning whatsoever. And I just need to emphasize too that planning that you do today will pay off in the future. And actually planning that you do today will help your current business operations, and we'll talk a little bit about this. But questions that you need to ask yourself and are going to come up is, so when is the transition? Is it this year, next year? Keep in mind that selling a business, depending on the size of the business and the type of the business, it could take a year or longer. Then the question is, what does it look like? Are you going to be staying on for 30 days, 60 days, 6 months? Typically, there's a transition involved from the previous owner to the new owner. And so what does it look like? Something to think through. Do you want to stay on for a little while? Do you need health insurance? If you currently offer health insurance to yourself and your employees, when you sell a business, are you going to have health insurance? So that's just another thing to think about. And then, what will the new leadership need? What are the new owners going to need? If they're current employees or family members, that transition is much more straightforward. If they've been in the business, they usually understand more or less how things work, and it's pretty much more straightforward than if it's someone buying the business, a new person that's not involved in it. And so then, if you're in their shoes, they're going to have a lot of questions. They're going to need a lot of information, and we're going to talk about that as we go through the presentation. So then the last part of the planning for the transition, and is probably one of the first steps, and maybe the most importantly, is what is my business worth? For many of us who have businesses, our exit strategy is selling the business and going on to whatever next, whether it's retirement or starting another business. And whatever you can get out of this business is going to determine whether it's too early to sell, or if you're going to have enough to do what you want to do. So those are things that are important to consider. So let's look at what's your business worth. Let's talk about that a little bit. So Aaron, next slide, please. So from a business worth point of view, it's not an easy question to answer. And it's the whole business valuation and business selling market. It's a little bit like the real estate market. Businesses are fairly unique. You may have, unless you've got a convenience store on this corner and there's one across the street, that's very similar to you. Businesses have their own customers, they have their own location, they have their own, various markets that they address. So there's a lot of variability in businesses, which makes it that much harder to decide or figure out what it's worth. So at the end of the day, you're really going to need some independent third parties. And they're going to help you figure out what your business is worth, what you or they think it can be sold for. And you really need these third parties. For starters, as an owner, you've got way too much investment, from an emotional, psychological perspective, to give an independent valuation. So who is that on the market or out in the business world to help you figure out what your business is worth? For the most obvious thing are business appraisers. They're out there, they're certified business appraisers. They've been trained and have taken tests to get these certifications. They're fee-based, so you'll pay them somewhere from $1,500 and up, depending on the size of your business and just the level of involvement they need to get into. You also have business brokers. And these folks are the guys that will work with you in selling your business. And they will typically, give you an appraisal at a high level, or at least an evaluation of what your business is worth. And that's strictly from their perspective, working and selling businesses and seeing businesses on a daily basis. But their goal is to get a commission, to get a sale and get a commission. So they're not necessarily completely unbiased. However, that said, they don't want to spend a lot of time marketing a business at too high a price, because they're not going to get a sale, and it's going to be wasting their time. So, again, it's the business selling businesses and evaluating businesses is a lot like the real estate market, in that in the real estate market you've got realtors, which are basically brokers, and you've got home appraisers. That will come in and appraise your house, to find out what it's worth for when you want to get, get your mortgage. And that's really not much different than a buyer coming in to buy your business. They're going to end up need to get an appraisal as well, so that the bank that's lending them money will be able to justify the loan. So when an evaluation occurs, it's typically going to involve, historical revenue numbers, and what's called seller discretionary income, with comparable businesses and or using industry multiples. Seller discretionary income is a calculated figure based on adding your salary and any other benefits you may get back to, so they can kind of assess what the business is creating from a value point of view for the owner. And comparing the business to other businesses in industries, what they typically will do there is they'll either take seller's discretionary income and multiply that by some number, whatever, based on whatever that industry can justify, or what the traditional multiples are. So you'll see that when people start doing evaluations. But after all of this, after all said and done, the real bottom line is your business is what is worth what someone will pay for it. And that's true of almost any sales activity. Someone can tell you it's worth whatever, but unless you can find somebody that's willing to pay that to you, it's not worth that until that happens. So just keep that in mind, and also realize that that's part of the reason that you need a third party, because for those of us that have businesses, and I'm suspecting most of you do, or you want to have a business, you have a lot of investment, as I mentioned earlier, in the business, and you're going to believe it's worth a lot. And you really need to have someone who doesn't have that investment to be able to give that assessment and use some data to determine, what it can sell for. So keep that in mind. All right, Aaron. So the key in my mind is you really need to put yourself in your buyer's shoes. And they're going to have potentially a lot of excitement at some point in the buying process, but they're going to want to know, up front. It's like, why should I buy this business? Is it affordable? Is it profitable? Is it stable? Affordability goes back to how much they're going to have to borrow, how much they've got to put into the business, and will they be able to pay that loan back from the income generated from the business. And of course, profitability, I think we all should understand that. If the business is not making money, it's not going to really pay a lot of income, pay you a lot of salary. It's not going to pay a bank loan off. Stability really goes back to, are the revenues flat or stable, level, or increasing? If they're decreasing, obviously that's a concern for any buyer. If individual customer segments are decreasing, that can be a concern. So really what customers, buyers want to see is, revenue is stable or growing, individual market segments are stable or growing. They just want to believe that when they buy the business, they're going to be able to be successful. And as a seller, you want them to be successful too, because typically you may find this as you go through this process. If you're a seller and your buyer is going through the SBA, there's a requirement for a seller to take back a note. So that way you've got some proverbial skin in the game. So back to answering the question of why buy this business. So we talked about affordability, profitability, and stability. The next question is industry knowledge. Does this buyer have knowledge of the industry that will help them be successful? Or are they trying to do something they've never done before? Because if they're doing something they've never done before, I think it raises a red flag. Certainly would in my mind if I was selling my business and someone wanted to buy it and they just thought it was going to be cool to run this business. That's really not a good recipe for success. And there's lots of other factors in addition to these things. I mean, it could be, where's your business located? Is it relocatable? Some businesses can be moved, easily. If you don't have any real estate or don't have any, large assets that are not portable, so to speak, that makes the relocation aspect a lot easier. Some folks are buying businesses they don't want to move. They want a business that can move to them. So that's another aspect or another factor of, if you're evaluating a business, of why you want to buy it. But for a buyer and for a seller, buying a business is a highly emotional process. For the seller, it's like, what am I going to do after I sell this? For the buyer, it's, can I be successful? Can I make a go of this? Very often it can be a new stage in their life, and they could be just full of excitement. So it's important for you to understand these aspects, and put yourself in the buyer's shoes as you go through the process. All right, Aaron, next slide, please. So as buyers looking at this, back to putting yourself in your buyer's shoes, it's like, what do they need to know to make the best decision? Just like for an appraisal or evaluation, there's a lot of numbers and data that's going to be asked of you as the owner. From a numbers and metrics perspective, typically there's going to be revenue history, and we talked about stability, like sales stability. Well, this really hits on 5 years of revenue history. So you're going to want to know how that's looked. Is it trending up, trending down? Did you have a peak out of those 5 years and then back down? They're going to ask you why that happened. You need to be able to explain that, but they're going to want that kind of information. They're going to want information on key markets. If your business addresses 2 or 3 different markets, they're going to want to know about each one of those markets. And as an aside, if you do address more than one market, it's probably a benefit to the business, because it's the old "don't have all your eggs in one basket" aspect. If you're buying the business and you're addressing one particular niche, and customer or prospect to buy the business asks you, so, well, what happens if this particular market segment tanks? What's the business going to do? If the answer is, well, we're going to tank, it's not going to be a good answer or give them a real good feeling. Similarly to revenue history is profitability profile. And by that I mean, what does the profitability aspect look like over time, both for the whole business and also by key markets or key segments. So again, it's important to know if you've got 2 segments that are doing really well and one you're not profitable on, but you were a year or 2 ago. And so the idea is, hopefully when one thing is down, something else is up, and you can show stability, in the business in a total. So then they're going to know about customer mix and distribution. A typical question is, give me your top 10 or top 20 customers, and you would typically obfuscate the names. They want to know, do you have one customer that's more than X% of your business? Maybe it's 5%, maybe it's 10%. 10% is kind of the usual kind of norm that you hear, I think. You've got a 10% customer, and what if you lose that customer? That's an important question to understand, both the answer to and the ramifications of, you losing that customer. And that's the kind of thing they want to know. It's like, what does that mix or distribution look like? And then finally, on the other side of the coin, from a customer side, the other side is the suppliers. How many suppliers do you have? How long have you been with each one of those? How stable are they? Do you have any supplier redundancy? I know from a personal case, when I bought this business about 10 years ago, we had a couple different suppliers for different products, and one of our suppliers was not particularly stable, and I was concerned about it. And fortunately for us, I found another supplier as a backup, and it proved to be true that that one supplier I had that was unstable, they went away, and they filed bankruptcy and closed up shop, and affected us significantly. But we did have a backup supplier. It didn't take us too long to get back up and running with that supplier. So we were fortunate in that regard. It's always good to have some redundancy if you can, and it's not always easy to do. If you're forcing things that, like, for example, used in tarps, like things and various hardware, backup suppliers is the one on the hook, so to speak, at one time, because you may have volume purchases from one, and if you divide that up, you lose your discounting power from the buying, your discounts from the supplier. So you just need to know what the alternatives are and be able to answer a prospective buyer question as it relates to that. So expect to provide 3 or 4 years of federal tax returns. They're all going to ask for that, and hopefully you've got clean books and clean tax returns, because that will show them that you're running the business in just an upfront fashion. Expect to want company financials included in your historical P&L, with comparisons for 3 to 4 years. Cash flow summaries for 3 to 4 years, typically by year, as well as the last full year of your balance sheet with comparisons to previous periods. And again, all of this is to give them a snapshot, comfort level that this is a solid business that they're trying to buy. So, okay, Aaron, next slide. So from getting the data on the financial data and the customer data on the business, one of the next most important things is they need to understand key processes. And every business has got processes. I'm sure all of you have got processes in your business. The question is, you have to ask yourself is, are these processes documented, and could someone else do them other than me? And if you've got a staff, and you're just managing your staff and they're actually operating or following the processes, then you're probably in fairly good shape. But if you've got a lot of responsibilities and you own the processes in your head, and you don't have them written down, think about what a new owner or a prospective buyer is going to look at. It's like, I've got to learn all this. It's not written down. How long am I going to have to keep this former owner around so I can learn this? That's going to be a question, and they're going to figure out the best way to answer it. And if you do have staff, you're probably in pretty good shape. And even with staff, you still want to have processes documented if you can do that. It's a pain to do. I completely recognize that. But it's something that will just help you be more successful in selling your business. And if you do have staff, and even if you don't, as I mentioned earlier, there's typically going to be training or education that's critical and part of the agreement when you do sell the business. Very often, the previous owner will stay with the business for 30 days or some period of time that the buyer feels is necessary for them to be comfortable with the business. And that's typically negotiated up front. So it's not something that you're going to sell your business, then, oh, by the way, I need you to stick around for 6 months. That's not going to happen. And if it's not contractual, you don't have to do it anyway. So, but ideally, it's something to agree on, and it works out. So it's a positive thing for everybody. It's also good that, from a process point of view, that you have processes for everyday and recurring operations. And that can be, there's several things that could fit into that, and we'll go over some of those later. How do you enter an order? Someone calls and wants to order something. How do you do that? Maybe you know how you do it. Maybe you write it on a sheet of paper. Maybe you pull up a screen on QuickBooks or some other software program. But how do you put that in? And does it vary by the order type? If it's a credit card order or a cash order, maybe you do something differently in each case. Or maybe if it's ordering something that's in inventory or something that has to be built, maybe you require money up front. So all of those are, could be treated differently, and having those written down in some fashion so that a prospective buyer can see those and just see on a piece of paper and go through this. This is how this works. Is going to give them a much higher comfort level when they start evaluating your business. They're also going to want to know, from a process point of view, key contacts, whether it's suppliers, partners that you work with for things, or customers. Obviously, they're going to know at least at closing or post-closing, who are the customers, who do you interface with, what's their buying patterns, why do they buy what they buy. All of that's going to fit into key contacts. How many suppliers do you have? Who do you talk to on a regular basis? Do you know the owners of those suppliers? If they're a small business, if they're a large business, how far up the chain do you know the management? Back to just what the relationships are and how in depth are your contacts. But they're going to want to know that information. They're also going to want to know the necessary equipment to run the business. Particularly, this is in the case of if you make products. In the case of my business, I'm a wholesaler of industrial fabric. We don't make anything necessarily, so we don't have any equipment per se. But if you make tarps, for example, you're probably going to may have a cutting table and something to help pull out those rolls or mount the rolls, and maybe automated, to measure off the rolls. You've got, welders, various things to help cut, material. There's just a whole host of things you might have. You might have your own trucks. But in general, any equipment that you've got, hopefully it makes you or allows you to make the same product every time in a quality state. And that's part of the idea of having equipment, so that you can make a quality product and replicate that quality. And that's going to be critical for a new owner. If you're making everything by hand, then the people that are making that, they're going to be critical to the product that's going out the door. And so that makes that staff person, invaluable to the business. If you're using a piece of equipment that someone can train up on and learn how to use in a matter of hours or days, that would allow a new owner to replicate your quality in potentially a short amount of time, because he's using the same equipment, even if the operator changes. So that's all. All of this is important to a buyer, and it all should be, at the end of the day, in the form of documentation. So these are things that are written down that are important for buyers. Okay, next slide, Aaron. So continuing on, the theme of what do they need to know to make the best decision. They're also going to know what they're buying, what's being transferred. Typically that falls in the category of assets. If it's an asset purchase, two types of purchase typically are assets: asset purchase and a stock purchase. Unless you've got a C Corp, that's not something that you're probably going to have, but if you do, then it could very well be a stock purchase. But typically it's an asset purchase. Then you get into types of assets: hard assets and soft assets. Hard assets typically fall into the category of property, plant, and equipment. You'll see that on the balance sheet. And that's, do you own the lot that your business is on? Do you own the business? Do you own any trucks? Do you have equipment that's typically been capitalized in your facility? Those are all hard assets, and those typically will be listed, because the buyer's going to know if he's buying it. Maybe you've got a forklift, and they want to know if they're buying a forklift. We bought our business 10 years ago. The previous owner had a forklift, but he wanted to keep it, and that was fine with us. But we needed to know it up front. Also, from another type of asset are soft assets, and those typically fall into the kind of things like software and patents. You may have, if you're in the Tarp business, you may have a patent on a particular part that is, made to replace, a part on a particular system, and you think it's a better way of doing it, and you design this new part, and you've got a patent on it. That sort of thing is really important to prospective buyers. Software, maybe you had someone write an app for a phone, for cell phones, so customers can order from you just from their phone. Well, if you do, that's something that they would want to buy, and you typically want to transfer. So that's another example of hard asset and soft assets. Customer lists, that's typically going to go with the sale, because obviously if they don't have the list of customers, they're not going to be very successful. Contracts. Do you have any contracts, with suppliers? Do you have contracts on your building, or is it leased? For example, you have contracts with other entities. So in general, those are all things that may or may not transfer with the business, and you need to understand, what the status of them, what they will be when you do sell the business. Also, receivables. When you sell your business, you close at a point in time. There's going to be orders that people have placed, potentially, and they haven't received the material, or they've received the material, but you've given them 30-day or 60-day terms. So if they owe money, then that's a receivable. And if that falls into, if when you sell the business, you keep the receivables, then you're going to have to collect that money. Now, and that you need to work through. There's all kinds of potential hurdles there, but it's not unusual for receivables to stay with the seller. And that's fairly easy to reconcile in the sense of you're the one that sold it, and it was your inventory that they bought or they used. It was used to make whatever they bought. So you getting the money for that at one level certainly makes sense. Okay, next slide here. So let's talk about high-level steps a little bit as it relates to getting ready to sell the business. And again, this is a little bit like processes. You can have processes, define processes now, document processes, and doing it now will help down the road, will help your business now as well as down the road. So one important step as an owner, and most of you, if you're our business owners, you probably already know this, but it's delegate. You need to delegate activities as much as you think are reasonable. And the real factor in that is you need to don't make yourself indispensable. In other words, if you are required for the business, how is the new owner going to run the business if he feels like you're required? You're going to have to fill they're going to have to fill your shoes. And so the training level that may be necessary for that is another tier than if you're not indispensable. So the key is delegate. That's important. And one test of that is, how does your business run when you're on vacation? And at one level, I'd almost ask, if this was a regular presentation, I'd say, everybody raise your hand if you don't take vacations. As business owners, I think we all know it can be hard to take vacations. I can speak for us. We had one key hire a few years ago that really made a world of difference for us taking vacations. And I think it's important that everyone get away from their business from time to time. So that's true when you're running. Definitely true when you want to go to sell your business. If you can't take a vacation now, how is a new owner going to run the business when you're not around? So you need to think about that. Now, the second step, first one was delegate. Second step is organize. And it really goes back to documenting these procedures, creating them and documenting them. If they're in your head, write them down. It can just be words, or it can be like a block diagram. Do this. After that's complete, then do this next thing. Then ask this question, and then do one thing if it's one answer. Do this other thing if it's another answer. But the key is, get it documented. Get as many of them documented as you can. A new buyer, if you hand him a binder of processes for your business, he's going to look at you first like you're crazy, probably, because few small businesses have these things. But it's a good thing to have. The next thing is key business metrics available. You probably run reports fairly often on sales and production and aspects of financials. Have those where you can get them fairly readily and they're fairly updatable. Don't have a sales report from 2 years ago that you don't have a current one, or don't have a P&L from 2 years ago and it's going to take you weeks or months to get a new one. If you keep things up to date, you're going to be better off both running your business, but also for a prospective buyer. And I'm sure these are things probably most of you know, but I think it's worthwhile just remembering these things that prospective buyers will want to know what these things what they look like, and where are you in your business. So let's talk about example processes. I mentioned that earlier. Next slide here. So I just picked a couple that may be worth, that are pretty much true in every business. So the first one is quote to cash. Every business sells something, and every business collects money for it, hopefully. I know this past year may have been a tough year for a lot of us. Hopefully, you continue to move product and quote product and get cash for it. So in general, quote to cash process looks something like you generate a quote, you get an order. With that order, you have to, if you're going to make something, you have to take that order, make sure you've got inventory for that order, get that inventory into some sort of production flow. And when that, then there should be some sort of instructions on how that workflow is done by product. If it's a one type of tarp, the flow may be this way. If it's another type of tarp, the flow may be different. But you typically have those processes. You may not have them all written down, but I guarantee they exist in your business. And if you can write them down at a high level, prospective buyers are going to just eat that stuff up. So it's just a good thing to have. So there's potential. There's a lot of things in the quote to cash, and it varies by business. But this was just meant to be an example of something, a process that you document. How you manage your inventory, that's an important process. How do you forecast? We're a wholesale business, so I'm constantly doing forecasts, ahead for next year, and when I think I'm going to need things. Looking at my inventory, interfacing with various mills that we buy from, making sure I can get product when I need it. And I think a lot of you probably know things are really difficult in the supply chain right now, and lead times have gotten particularly long. Shipping containers from Asia, Europe, have all gotten extended, the shipping times. So it's even more important that you forecast and get your orders in sooner rather than later. And so you need to have a process for that. And a buyer, if you have that and a buyer sees it and can understand it, it's going to add value, or at least make it easier for you to transition your business. Similarly with ordering, how are orders placed? Do they differ, depending on what's being ordered? What are the terms? It's just, there's variability there. Whether you take a credit card or not. Those all come into how you manage your inventory and how that process overall works. And then how do you count for your inventory? Do you track inventory as in like first in, first out, last in, first out? Maybe it doesn't matter. Those aspects are important as it relates to overall accounting for the business and profitability, because sometimes products change in their cost, and then that gets affected in your profitability as it relates to if you're using lower cost items versus higher cost items. And so that's all important from a process point of view, how you do that. And then how do you interface to your customers? I mean, at the end of the day, everything starts with the customer ordering something. And how do you do that with your customers? How do you track their orders? How do you acknowledge their orders? What's the process? Who does that? When do they do it? How do they do it? Is it email? Is it fax? Is it phone calls? Is it something that's built into your system for QuickBooks or whatever system you're using? When you do get an order, if you don't have it in stock, how do you set expectations for lead times for these customers? Is that something that's the same no matter what they order? Does it vary by product? Or does it vary by product and time of year in which they ordered it? If your business is seasonal, my business is somewhat seasonal. If someone orders something, in our off season, I may not have it, and it may not be in stock for a couple months because I've got a container coming, or need to have a container coming to hold that product. So these are all some examples of processes in the business. All right, Aaron, next slide. Then other examples of processes and related to, for example, production equipment. How do you maintain your equipment? Is it done internally? Do you have defined schedules? every 60 days, every 90 days, whatever. I mean, maybe you've got welding machines, sewing machines. Um, those things typically require some sort of maintenance, preventive maintenance anyway. And do you have a schedule for that? And how do you do that? Do you take those down during working hours? Do you have backups that you slide in? I've got one customer that's got a bank of sewing machines that are replacements for the ones they use on a regular basis. When something fails, they'll pull one of those out and put another one in. Then it allows them to maintain their production flow and not impact the production flow while they're repairing something or maintaining it. Or do you have third parties? Do they come in? Is it scheduled? Do you schedule it, or is it already scheduled? Do you have some predefined schedule for replacing things? Maybe it's changing something on a piece of equipment. You just do it every 6 months, because if you don't, it's going to break. Think of it as like a timing chain on your car. You'll see those with a lot of cars that I can replace every 60,000 miles or something, whether you need it or not. But that if you don't replace it ahead of time and it breaks, you may blow your engine. The same thing may happen, with one of your welders. If you don't replace something ahead of time, it may go down and you may be down for days. And most of us can't afford that to happen. So, these are the kind of things that, as you're running your business, you typically have these processes in place, but you have them documented, and in a fashion that someone can learn them and follow them. And then there's things also, related to, talked about equipment. There's like assets, other assets like buildings and vehicles. If you've got your own trucks, do you have a schedule for maintenance on those? Do you have someone in particular that does that? So at the end of the day, it can be a very long list of processes for a business. No one will expect you to have all of them. I think it's worthwhile to sit back and analyze which ones are important for your business, and try to document them. Even if it's just at a high level. Take order, enter it into QuickBooks. Give to the production floor. Quality check at step A, quality check at step B. Just at a high level, that's going to be better than telling a prospective buyer, well, come into my shop, I'll walk you through how we do it. And if you don't have anything written, and he leaves, he tries to remember, now, how did they do this? If you're able to give him some documentation, it's going to mean a lot more for him, and it's going to mean a lot higher likelihood of success for you as it relates to selling your business and then transitioning, which is really what we're talking about here. So, okay, Aaron, next slide. So in summary, we talked about a lot of things, but not a lot of detail about anything in particular. Again, just to reiterate, there's just tons and tons of things that are involved in succession planning. But at a high level, we touched on most of the things at a high level. But to summarize, first, I want you to remember that preparing emotionally and mentally for this is important, and it's a process. You need to go at your own pace. Selling your business is an emotional, it's an emotional event for you. Similar for the buyer, it's going to be an emotional event. You need to make sure you're ready as best as you can. And how do you do that? A lot of it boils down to introspection. And none of us want to sit back and stare at gaze at our navel, right? But sitting back and thinking, like, why am I selling? What's my motivation? Is there something else I want to do that I really love to do and it's going to fill my days? Or am I going to do something else? So thinking through those things is really important, but only you can answer these questions. No one can answer them for you. You can get people to help you with them, though, maybe even just help you through the process, whether it's personal, family and friends who know your situation, who know your personality, they can all potentially help you. Ask questions like, well, do you really think you can play golf every day? Do you really think you can go hunting every day? Or whatever it is you like to do. They may know you better than you know yourself sometimes. So friends and family can certainly be an asset to help you figure that out. And lastly, we touched on these, but professionals that help. I talked about appraisers. I talked about business brokers. You also should have a lawyer and an accountant. Those are the three professionals you really need. You'll probably deal with a broker the most, because the broker is going to help you figure out, what you should list your business for, and what they think it's worth, and you need to decide if that's something you're okay with. And they'll explain why they got to that valuation and try to help you understand that this is really what it is. An accountant will help you say this is what you get to keep after you sell your business, because we all know there's the tax man cometh. So they will help keep you out of trouble. They can also help with some of the processes as it relates to financial processes, as you go to develop them or document them. And a lawyer will just make sure that you're thinking through all the details, all the ramifications of a sale, all the potential liabilities you may be stuck with, if there are any, but just risks that you're taking that aren't covered in your contract or asset purchase agreement. So those are the three that I think you should have, and I would focus on an accountant that works with business transactions, as in business sales and purchases. Similarly with a lawyer that helps with business purchase, asset purchase agreements or stock purchase agreements, and then a broker that knows your kind of business. The last thing you want to do is get a broker that is really good at selling convenience stores, and or retail, and you've got a business to business type of business that is wholesaling and has production, and the broker is not familiar with that. That's going to be, they're not going to be able to give you a real good valuation. They're not going to necessarily know the best place to market it. So it's important that you get a broker that is at least familiar with your kind of business. So anyway, that pretty much covers the things that I wanted to talk about. And I talked about a lot of things pretty fast, so hopefully it wasn't too fast. I'm going to ask Aaron if there are any questions that anyone's had, and see where we go. So we've got one question. Do you think it'd be best to get more than one quote for the value of your business? The answer is, I would qualify it as yes, depending on what you want to do. You can get a business valuation for $1,500, $2,000 from a professional business appraiser, excuse me. But you can also get a broker. If you think you're thinking about selling the business, find a couple of brokers that you think could sell your business, and ask them to tell you what they think they would list for, and see, ask them to justify that price, to ask them to tell you why they think it's what it is, and do the same thing with another broker. And when you get both of those, you can compare them, and don't feel guilty about telling them, well, that's not what I thought it was. I'm really not ready to do anything. Brokers are used to that. They might push you to try to sell it anyway, but they'll also keep you on their proverbial Rolodex, and they'll call you up periodically. And I mean, I still get calls periodically from one of the guys that helped me buy this business. And it's like, oh, are you ready to sell your business yet, Rob? I've been telling for years, no, not yet. So, they'll keep in touch, and you can get a couple of quotes. They're not formal quotes, but they are good enough to kind of give you a sense. So hopefully that answers your question. Any more questions? Well, if that's it, thanks everyone for your time. I don't know if Aaron or Christine wants to chime in, but I'm going to be at the roundtables after this. We've got of questions we're going to talk about there. But if anyone wants to contact me directly, my email address is on this last slide. I'm certainly willing to talk with anybody, if you've got any questions. So thanks for your time.
Well, great. Thank you, Rob. That was great information, and we appreciate your time and your expertise. As Rob said, he's going to remain on the platform. So if you have any questions for him, you can reach out to him at his table. And in a few moments, or in about 10 minutes or so, we are going to move into the roundtable discussions. So if everybody could please congregate to just a couple of tables on the platform, maybe if everyone could go to tables 1 and 2, that would be helpful. And we'll get started here in just a little bit. Thank you.
Thanks, Christine.